This is B Water Investments' first ever market analysis and market update via voice or video content. I am the CEO, Michael Zitron, and B Water Investments was registered on September 1st, 2021. Prior to registration, I took my personal assets and back tested them against a series of different formats regarding technical analysis. And around 2014 and 2015, I found a teacher and a process that resonated with my convictions and my confidence in how charts could be interpreted today and how that would parlay into future price action. Something I did prior to registration was that I would share my targets with confidence and conviction, and that would follow the entire trade thesis. And I've not done that since registration because of compliance protocols and because of the hats that I need to wear, and that the clients are more important than the research that justifies how they feel. But I think that's different now. I believe it's important that the clients at B Water Investments have access to my time and access to the technical analysis, which forms the conviction and the confidence, which develops the investment philosophies and thesis in which the positions that you're in. So this video today is for you, perhaps requested by you without directly asking me for it. So here we go. Seeing is believing. And regarding technical analysis, that is the easiest part of how to interpret the data and the numbers presented in a visual chart. It's not what we think. It's what we see in the chart that allows us to forecast or measure, reduce positions down or increase positions up based on primary ingredients like price action, aka candlesticks, secondary indicators such as the relative strength index, and then the system which B Water Investments primarily focuses on, which is symmetry. Now, it's not the only process and system B Water Investment uses. For example, seasonality is a strong component to tie into symmetry targets to the upside or symmetry targets to the downside. So usually they coincidentally collide. Seasonality from history matches with symmetry from prior historical moves. And we have a thesis and an arrangement of beliefs that causes us to maintain long positions and increase exposure as the market falls, as is the case right now. BWI's view on the current market condition is that the seasonal weakness that typically plagues August and September and October is not a time period for us to sell all assets and count our chickens before they hatch. Because B Water Investments' view for its clients is that we're here for the long term and that we just left a tremendously rigorous and aggravating bear market where the downside moves were choppy and caused a lot of questions about what is support, what is resistance, will the market move lower, is this the bottom? So let me explain to you how conviction looks in hindsight based on one chart, the S&P 500 index. It's a cash market index, meaning it only shows price action from 9:30 until 4 p.m. Eastern Standard Time. And that price action falls under the ticker SPX. We have a monthly chart, and I'm here today to break down why B Water Investments not only believes that the bottom was in October of 2022, but show you in a picture why seeing is better than any other alternative, like listening to the news. So, in order to believe the conviction themes, let's review them so we all know exactly why you believe, why you're in what you're in, and what we expect to do about it. Number one, we are going to review what we call the white downward arrow. Number two, we'll discuss the exponential moving average on the 9 EMA, the 9 EMA. And we'll also discuss in three, the new highs, the yellow circles, and the yellow lines. And finally, four, what symmetry looks like and what it can potentially forecast. So in talking with white downward arrows, I want you to go to the very left-hand bottom corner of the screen and stare at that tiny yet very emotional candlestick on the monthly chart in October 1987. If you're familiar with history, the 87 crash, I think it was called Black Monday, caused incredible fear in the markets. However, 12 months later, and you see a downward white arrow. 12 months later, from the fear of the 87 crash, was higher lows and higher highs on a daily chart. Now, this far away, zoomed out on a monthly chart, you can't see that, but you can see that the arrow points to a higher price in the chart. Look at all the appreciation in assets of the 500 companies that make up the S&P 500, the market cap weighted index. Look at the right. I want you to try to put yourself in the news, listening to what they're saying, either present day on September 26, 2023, or recall what the fear would be like in 1987 on the next day of trading in October. So the idea is to cement your memory to the fear and then look to the right. Let's take the same example and talk about the catastrophe that happened to tech stocks and internet stocks after the dot-com bubble popped. What I call in Waconomics the death of overhead, or what I called during the writing process in Waconomics the death of overhead. So in the years 1999 and 2000, the NASDAQ started to rise, and the S&P 500 in conjunction rose with that. However, when stocks started to decline from 2000 all the way to March of 2003, tech stocks, internet stocks got decimated. And on March of 2003, in that month, a new low was placed in the S&P 500, and 12 months from that low, you find a white downward arrow. That white downward arrow followed months and months of price appreciation, which got to an all-time new high in the years of 2006 and 2007. You can see that. 12 months off the lows. And we continued higher. Let's go to the great financial crisis. When we peaked in 2006 to 2007, we tried to get above all-time new highs that were connected to the 2000 highs. And we went lower. The bottom on March 9th, 2009, offered some of the most sensational fear I've ever witnessed when I personally traded my own money. I started trading in July of 2008, and I can tell you that this was not the introduction to the stock market that anyone would hope for. The market is, over history, especially the S&P, bullish. But I walked into falling skies, seeing 500-point down days in the S&P going into March 2009 was anything but hope tied to it. So I want you to pay attention to the white downward arrow 12 months off the lows from March 2009. Yes, we pulled back 12 months off the lows, and we did so a little later in 2012. But eventually we got to all-time new highs and kept on going. Let's fast forward to February 2020, looking at the all-time high made in the S&P right before COVID hit. The COVID crash from the highs of February 2020 took us to the lows of March in 2020. And in roughly 24 trading days, we moved about 34% down in the S&P, which is roughly 9% more than we did in 2022. The joy behind that crash was that we recovered quickly, got above all-time new highs that summer, and 12 months later, off the lows in March of 2020, is indicated by the white downward arrow. What do we have in common? In September 2023, to the 1987 crash, to the dot-com bubble, to the great financial crisis, and to the COVID crash. We have 12 months off the lows and yet not another new low. So I want you to look at these white downward arrows, and I want you to look at the individual stocks you could own. At the time of video, I can't disclose to prospective clients what the firm is into, but think about a name. Maybe go back to 2009, sometime in the summer, and look at what the price was then. Now, if you look at Apple, please realize that the stock, I believe, has split 3 times since 2009. Apple got up to $600 or $700, got up to $400 or $500 another few years from there, got up to $500 or $600 after COVID, and every time Apple split. It was a positive split, meaning that if the shares of Apple went to 700, you might have gotten 7-1. I'm not sure what the splits were in the 2 splits that occurred before COVID, or I'm not positive whether it was a 4-1 or a 5-1 split after COVID. But my point is that Apple split 3 times in less than 15 years. And when you look at the price of Apple now, you've got to apply the split to its current price, which means the share price is a lot higher than it looks. So if we go back to 2010 and you look at a share of Tesla, or if you look at a share of Amazon, were you thinking about what the current price of a certain stock was in 2010, or were you connecting the fear from seeing the homeless people on the street in 2008 and wondering if you would have a job in 2009 and wondering if there'd be food on the table? Well, I can tell you that the news does not help how you feel, but what you see in the picture. What technical analysis provides is belief. So have some faith that us pulling back into a seasonal weak time of year, which was expected, is in line and coordinating with prior historical moves. Number 2, the 9-month exponential moving average in the magenta line in the chart is either above the candlesticks or below the candlesticks. If candlesticks are above the magenta line and trending higher, we're in a bull market, especially if we've gotten above all-time new highs. When the candlesticks are below the 9-month exponential moving average, simply put, if we stay below and can't get back above the magenta line, as you can see in other bear markets, it can be damaging to individual stocks. But right now, as was the case in every other bear market occasion in this chart since 1987, that once we've gotten below the 9-month exponential moving average, the magenta line, and then gotten back above it after a substantial pullback or decline or recession, however you want to call it, and if we stay above that magenta line, that's a solid line in the sand to measure the trend. And right now, in September, we are above the 9-month exponential moving average with price action. So we can ground ourselves with technical analysis and even show that in prior new bull markets, there were occasions like in 2011 or 2012 where we briefly get below the 9-month exponential moving average, But if we're patient, we remind ourselves of all the price destruction that occurred from the current bear market and that prices like to revert back to the mean or back to what they're supposed to do, which is inflate higher. We are not supposed to experience too much inflation because that's what the Federal Reserve's mandate is to do, to reduce our exposure to inflation through monetary policy. So what is supposed to inflate, because corporate earnings require inflation to increase prices on the goods they sell, is stock prices. That is true non-stated government inflation. So we've seen that when the white downward arrows appear, that's 12 months off the lows. And we've seen when the 9-month exponential moving average is below price and price is back testing it or checking back to the magenta line but staying above it, we're more in a trending friendly market that we want to be a part of, and that the risk to get out to be cute for a couple months is not the main mission here. So, as of right now, we're back testing the 9-month exponential moving average, and as long as we're above that 9-month exponential moving average come the end of October, BWI believes that the trend is most likely going to continue higher. Number 3, new highs are indicated by yellow circles, and the former highs that the new highs get above are denominated or demarked by the yellow lines. So in 1987, after the crash, 12 months after the lows, we have the white arrow. But as you can see, a few more months, a couple months, a handful of months, and we get above the all-time high before the October 1987 crash. Then we backtest that old high. We affirm that that's more support than resistance because we get back above it, and then we trend higher. So it's important to know, after one of the scariest market declines in history, the fear that plagued investors eventually led to all-time new highs, and look at all the appreciation that led into the years of 1999 and 2000. That's a lot of months, and in this case, a decade. Now, if we look at what happened after the dot-com bubble highs, and we see price decline into the March 2003 lows with what we call a double bottom, we moved up to all-time new highs. Yet we could not get above and stay above all-time new highs that are, demarked by the horizontal yellow line to the left. So if the new highs came in 2000, if we briefly got above them but could not stay above them, that's an easy area to de-risk. Because we say, listen, we got to all-time new highs, let's sell the rip, because that's what we're looking for, a reversion to the new high. And if the price of the stock or a basket of stocks, like a market, like the S&P 500, cannot get above and stay above its future all-time high, well, that's an area to consider saying, let's take it off the table. We'll worry about taxes at that time because we don't want another scenario like 2007 to 2009. However, let's fast forward 12 months beyond the lows of March 2009 is indicated by the white downward arrow. Prices moving up, briefly going below the 9-month exponential moving average, but then quickly getting back above once we were trending. So we eventually got to all-time new highs. The horizontal yellow line above the 2000 horizontal yellow line indicates the new high that was created in 2007 or 2006. I'm not sure which year that was. But if you notice the circle in 2013 around the former high level of 2006 or 2007, you will see that we broke above, back tested, and continued higher, creating a new bull market. So that is the theme, and that's what you should understand. New bull markets, according to certified market technicians, which I am not a CMT, but I will disclose that most CMTs certified market technicians acknowledge a new all-time high as the beginning of a bear market or the beginning of a bull market and the beginning of a new bull market. So if we're entering prices in 2010, in 2011, in 2012, and then we get to all-time new highs and keep on going, and we put positions back on and maintain our conviction in the long-term trend, the appreciation that occurred off the March 2009 lows happened not only in the S&P, but dramatically in individual stock names. For example, like in the past, Apple has performed. So what I'm saying here is, if it feels choppy and fearful, that's what the news wants you to think. And if you stay long and follow a system that is trending, what is the next likelihood? Well, we can use 2020 highs as an example. In February 2020, right before the pandemic started roiling the globe, we see a new high in February. I think it was around the 20th of February, maybe the 21st. Anyways, that led to a dramatic sell-off into March 23, 2020 lows. But look what happened. Price recovered quickly, got above the 9-month exponential moving average, that would be in May, and then quickly got to all-time new highs, exceeded all-time highs relative to February 2020, back tested that area from the February 2020 highs. You can see the 2 red candlesticks, and then went. See, that's a trick in technical analysis about resistance and support. Breaking above resistance, back testing former resistance, confirming that former resistance is now support, and then going with a 3rd or 4th or 5th bar much higher, that's confirmation. Look at all the price appreciation that happened from the summer of 2020 to 2022, where the new all-time high at 4818.62 occurred on January 3rd, 2022. My point is that because we're 12 months off the lows, because we're above the 9-month exponential moving average, that we're trending. And it's no different to date than any other bear market since 1987. So, what other convictions do we have? Let's go to symmetry. So I'm going to try to make this brief and specific, but I will say this. In beauty, there's symmetry. And in nature, symmetry naturally occurs, and that symmetry comes from Fibonacci numbers. The Fibonacci numbers are based on mathematicians and their connection to nature. Seashells and Fibonacci are a good example. But often we say, hey, that, there's something called sex, money, power. Where do you think that comes from? Well, let's look at Tom Brady and Giselle. Very powerful people. You could say Giselle is sexy if you're a woman or a man. And if you're a woman or a man, you could say that Tom Brady is a sexy man too. Bottom line is, when you look at the right side of their face and the left side of their face, they are almost perfectly symmetrical. And yet they wield a high purchasing power when it comes to all their contracts. The same true is in the stock market as in the faces of Giselle and Tom Brady. If you measure the highs of the 2000 dot-com bubble, or in 1999, depending on how you look at data and which stock index you're talking about. In this case, we're talking about the S&P. And you measure down to the March 2003 lows, the distance from the highs in 2000 to the lows in 2003. If we take that measurement and move it to the highs in 2007 of the S&P, they measure 100% down to 791.85. The S&P bottomed at 666 on March 9th. 2009, but just shy of its 100% symmetry. Now, let's reinvent the same wheel and take the distance in the highs from the March 2020 lows that quickly came from the February 2020 highs. So we're measuring the distance from the February 2020 highs to the March 2020 lows, and we take that measurement and we measure down from the 4818.62 high in the S&P on January 3rd, 2022, and we get 3616.96, 100% symmetrical move from history. And the market reversed. It hit it in September with that big red ugly candle, quickly reversed, in October, on October 13th, striking it again, and since then we're up. Symmetry happens frequently on a daily basis, on a weekly basis, on a monthly basis, and on a yearly basis for the S&P 500. Now we have higher symmetrical targets that we can measure off the lows in October of 2020, and they're demarcated in teal. So I believe, based on this analysis, which is not a guarantee of any future results, but based on what I see, I believe we're more than likely to hit an all-time new high before we ever have to worry about an all-time new low versus the October 2022 lows. What I'm saying is we're not selling things even if they pull back substantially in August and September. We left cash on the sidelines, and as the market's fallen, we've started adding into positions. We're not trying to be perfect on every last down day. We're trying to make sure that we get some discounts even as your portfolio is falling, because we do not want to be worried about the market hitting new lows. We want to be worried about not having enough exposure on this pullback, because eventually we'll reach all-time new highs. Let's see if I can convince you a little more through the next segments. I know that charts aren't sexy and that nerds like to geek out with themselves, but this is your money. And I look at these prices, these charts every day to interpret the path of least resistance. And right now, Be Water Investments believes, based on this analysis, that we should have conviction themes in our mind and know what to look for. So we now know what to look for if we ever see a 9-month exponential moving average against the S&P 500 and what it implicates. Let's see what else we can find out. In the prior slide, we discussed conviction themes as to why we should believe in the current market structure, that it should lead to a new bull market based on history repeating itself. What most clients don't understand is that even though we are able to measure the symmetry from the COVID highs to the COVID lows, and the market did reverse, hitting that area at 36,1696 twice in September of 2022, and backtesting that area and holding in October of 2022. However, we were not able to get above the 9-month exponential moving average until about 4,000, and that area chopped around, especially in December of 2022, causing technical analysis to second guess that potential low. So we tested the area above 4,000 into the 4,200 area multiple times. So 4,200 was an area that was previously held as support. When it broke, it became resistance. And when we go to test it again and the market can't get above 4,200, the white line, we know that that is significant resistance. But once we get above former resistance, it now serves as support. So once the S&P 500 got above 4,200 and stayed above 4,200, we started introducing new funds into the market that we would use to account for a future all-time high, meaning that the new bull market that a certified market technician would recognize as a new all-time high, we want to position ourselves before that. Again, because we're looking into the future, 6 to 18 months out, and even longer term than that, we're looking to the right of the screen. If we look at the white arrows, we see a lot of right and stock market appreciation from that right. Now, 4,200 is a level that we broke out from, and in technical analysis, when we break out, we most likely backtest and then go higher. So not only is that horizontal white line 4,200 an area where we got heavily involved, it's also an area where we saved a % of money to put back to work in case we retested 4,200 so we could take advantage of those prices. Now, we don't want to be perfect between the area of 4,200 and all-time new highs. We want to be involved. The mistake of getting out, if we're above 4,200, is an opportunity cost that I want to remind individuals of, and the experience that happens when you get out thinking that you see something that's not happened yet, and that might not ever occur. So I know people from personal experience when I was trading starting in July of 2008 that talked about how they got out of the stock market. And I know people who help people show them why to get out of the stock market before the crash in 2008 to 2009. But what a lot of people don't realize is those smart people who got out and try to time a greater cycle might not have gotten back in. And they would have missed everything after that downward white arrow. So while it may seem choppy for clients to see their accounts move up very high and then pull back in line with the back test of 4,200, this is expected. If we stay above the 9-month exponential moving average, the magenta line, if we're above 4,200 at the end of October, when seasonal market weakness is typically over, then we probably have a higher likelihood of hitting that 49.18 and potentially in time that 61.08 on the S&P 500. So we can use 4,200 when we see the news as the arbiter of what's bullish and what's bearish. If we're clearly above 4,200 come the end of October, we are bullish and we will be 100% invested because we'll be taking care of all final cash positions into this pullback. The remaining presentation are just offering conviction bites, takeaway pieces of confidence that you can lend to your own knowledge when you look at the news and when you talk with individuals. So if the S&P 500 is above 4,200 by the end of October or higher, we're going to be looking for specific news pieces or vehicles, trading vehicles, to support our confidence. Number one is TNX. TNX is a proxy for the 10-year yield futures. So when we look at TNX, we've had a long-term target of 48.2 to 49.99. Often they act as magnets. If the S&P 500 is well above 4,200 and TNX is not getting above 48.2 or 49.99, it can touch it all at once, then that's bullish. Now, another way of looking at TNX, the way you might see it and hear it on the news, is the 10-year yield futures. So all you have to do is move the decimal on TNX to the left and you get the 10-year yield futures. We have given you those charts so you can see that BWI is looking at the implications of the S&P holding where it should and the 10-year yield hitting targets where it should. And if TNX or the 10-year yield futures reverse, that might be gasoline for the stock market. Another feature to look at to support the evidence as to why 4,200 and higher is a very bullish environment for portfolios and something to get excited about is Bitcoin. Bitcoin is not something to get excited about by itself, but its level and its measurements are, and we include that in the chart, and we want you to know that it's relevant to measuring what the market is going to use to outperform for investors. And sometimes when Bitcoin is performing well, so is tech, and so is growth stocks. So that is what we're highlighting is if Bitcoin is above 25,100 by the end of October, this isn't a bearish environment. It's a bullish environment with risk appetite. Lastly, we'll touch on some seasonality and symmetrical time. Just remember, in 2010, I'm not sure how many investors, individuals like you, were looking at names by themselves and saying, I don't know where there's going to be in 12 years, but I need to hold here. What you might have thought of is what the news was promoting, which was a wall of worry. And that's what we're getting right now in a perfect seasonal time of year. Here's the TNX chart also known as the proxy for the 10-year yield futures. This was an advertisement shared on June 1, 2022 with institutions, mortgage lenders, and bond traders. What we were suggesting when TNX was at 28.44, that the golden measurements circled in gold were potential levels of interest measured from time. So, if TNX gets up to 48.2 and that's the ceiling and starts to reverse, that is what we're looking for. 48.2 is the last remaining target from this advertisement sent a year and so ago. We want these levels to be hit, especially if the S&P is holding above 4,200 simultaneously. So the proxy from TNX is this 10-year yield. And as you'll notice in the writing here, you'll see levels that coincide with the old chart, which is 1983 to 1984 at 4.27. It mentions what you were just looking at. Anyways, we've had these levels outstanding for a long time at Be Water Investments. This 10-year target is, in fact, in the remaining risk for borrowers in 2023 gray zone as we speak. The price, during recording on September 26, roughly 7:04 p.m., is 4.538. So we're right in the middle. All I'm saying is that we want these targets to be hit. They're outstanding. Sometimes they act like magnets when they're this close when we talk about measurements in time and history. And we're hoping that this is the top in the 10-year into these targets. We'll never know until time tells us. Be Water Investments has prior roadmaps for Bitcoin, and it actually worked the opposite where price is a lot higher and we're measuring down to show that, hey, we need to stay away from this. This is going much lower into targets. But after a majority of the targets were hit from all the advertisement that we maybe shared on the internet through social media for different handles on our social media pages and Michael Zitron's personal pages. At any rate, we're now in the area where we've hit sufficient targets to the downside and hit sufficient targets to the upside. Now we're determining where Bitcoin's going to go. And based on the way Be Water Investments measure symmetry, it seems more likely because that 11,986 target was never hit when Bitcoin hit roughly 16,000 on the downside. And in November, bottom line is the reversal before the 11,900 mark happened. And now we're saying, okay, well, because a long-term bottom was basically achieved, now we should be measuring up. So if we don't get below 25,100, Bitcoin actually looks as one of the most impressive upside potential with pure technical analysis backing it. It won't matter what Goldman Sachs is doing. It won't matter what Morgan Stanley's doing. Right now, we're getting confirmation that larger banks want to create ETFs for Bitcoin to emulate the move in the cryptocurrency. That's a bullish sign when institutions are not only buying, but they're being a part of the broker-dealer exchange where they're making money on the actual buys and sells. So bottom line is if Bitcoin stays above 25,100 in October, I think, 36,380 is more likely. We could even push it back to early November. All I'm saying is that I prefer the teal at this stage in the development of the chart. It can always go to 22,140. And at that point, it's a measured move pullback that's already existed and would be natural. Either way, we're talking about small percentage moves for a name that will eventually move a lot higher in time based on the structure of the market. There's an old adage, sell in May and go away. And while that makes a lot of sense, I've seen markets completely overlook May, keep on going all the way till the end of June, pull back a little bit in July, rip after July 4th, and they never even considered sell in May and go away. So what I'm bringing to you is the idea that yes, you should be involved in stocks. However, just because the adage says sell in May and go away doesn't mean we're going to get market weakness. So at this point in the education for clients, I think the most important message to you is this, that the S&P was supposed to pull back here. And if we're trying to be cute and move away from 200 or 300 points in the S&P as we actually position ourselves above 4,200, it makes absolutely no sense in the long term to make too large of adjustments if over time we expect higher prices. So there's no evidence to suggest that higher prices won't come sooner rather than later. And the seasonality suggests all this pullback is just so everyone away on summer could have potentially gotten back in at cheaper prices than if they had not, gone to the Hamptons in May. I'm just saying that there's always a reason. People don't know in hindsight, and the news is definitely not necessarily a credible source, especially general television channels where they're focusing on different types of fear-based conversations. If the news was more self-serving to its audience, then it would discuss that we're expecting seasonal weakness. And so they would be more bearish into strength than they would be into weakness, but it's the inverse. And anyways, this is seasonality. I'm trying to share with you how things are seen through a market perspective. And if this is too rich, too technical, shame on me. I'll never do it again. I'm not going to comment on this chart because it's 100% hypothetical, suggesting that markets move in equal symmetry in time. I don't always find that to be the case, but I do like the secondary indicator, and I do like the momentum off a majority of the bear markets that we've had since 1987, for example. Anyways, this is a treat. I don't normally share other people's work, but I've listened to this guy, and he's got a process, and we got to respect it. I just want to say thank you to all clients, prospective clients, and anyone here just for education. It's a rare opportunity to get to work for people that you care about and talk with them about how you really see the market. And it means something to me to share because it says I'm coming out of my shell and going directly to the people I care most about regarding the work at Be Water Investments and or potential work. So I just want to say that I'm human. And in that experience, there are a lot of emotions that happen in the stock market. And our job is to take as much out of that emotion and noise and reduce it. And the reason technical analysis is holds a close place in my heart is because I believe that technical analysis is more proactive than the information that's received on the news. And that's subjective. But I will say, because I'm a human, I also make errors. So I want to correct myself and say that the absolute high in 2000 was March for the S&P that we talked about before. The actual low from the dot-com bubble, from those highs in March of 2000, was October 2002. I made the mistake of thinking a higher low was a lower low. Regardless, lastly, I also put my foot in my mouth talking about 15 years for 3 stock splits with Apple. I was wrong. It was 3 stock splits in, at this point, I would say 18 years. So the first one of those 18 years was a 2-for-1. The second one in 2014 was a 7-for-1. And the third one since I opened my mouth was August 28th, 2020 for a 4-for-1. So I thank you for your time. I appreciate you allowing everyone here to be human. And I want to say that this was fun and I'm looking forward to feedback. If for some reason you actually listened to this entire message and you thought it was educational, or if you thought it was a waste of your time, I would like you to use the safe word with me the next time we speak or see each other, and that be, I'm not sure I agree about the news. Thanks very much, guys. Please take the time to read the disclosures that Be Water Investments has set forth for its clients and prospective clients. These disclosures include the type of positions clients could be in and the trading vehicles that Be Water Investments would use on their behalf. We thank you for your business and trust.